Hello and welcome to Ticker Tapes. Today, we're back in the world of ETFs. Energy markets are front and center once more as far as ETF traders are concerned, and in a list of 100 popular and widely traded ETFs, the top 25 best performers in Monday's trade were energy-related funds. What's more, 17 of those funds performed positively over the previous 5 days as well, and if we look back over the long term, the average fund in this list was up by 46.87% year-to-date as of Monday's close. The drivers for these gains are largely geopolitical. Russia is playing a game of cat and mouse with energy supplies to Europe, and that in turn is driving natural gas and power prices on the continent to new highs. Dutch TTF natural gas, Europe's benchmark contract, has risen by 40% over the last week and by 67% over the last month. The tight supply situation in Europe has spilt over into global markets, and that benefits U.S. energy stocks and the ETFs that track them. Earnings at S&P 500 companies that generate more than 50% of their revenues outside of the USA, a group that is heavily weighted towards energy stocks, are growing at 10.2% per annum. That compares to a growth rate of just 1.2% for those stocks that generate the majority of their sales in the domestic market, according to data from FactSet Research. Last week, we suggested that short-term speculative capital had rediscovered its appetite for risk assets. That trend is reflected in data that tracks capital flows into ETFs this week. For example, SPY, the Spider S&P 500 ETF trust that tracks the blue chip equity benchmark, was the recipient of $1.94 billion of new money over the last 7 days, whilst QQQ, which tracks the performance of the tech-centric NASDAQ 100 index, saw $1.09 billion invested into the fund. Over the year to date, QQQ has grown by $2.84 billion, whilst SPY has seen $22.47 billion leave the fund. QQQ is down by 26% year to date, whilst SPY has fallen by 17.7% in 2022. The full scale of the errors made by ETF and ETN traders at Barclays was revealed this week when the bank announced that it would have to repurchase $17.6 billion worth of exchange-traded products, or ETPs, that it had erroneously issued following a breach of an exposure limit previously agreed with U.S. regulators. Risk management systems at the UK bank failed to highlight the breach, and the bank continued to issue and sell the products, many of which proved popular with traders in the aftermath of Russia's invasion of Ukraine. Barclays may now have to pay a premium price to holders of those securities, and the bank has already put aside $650 million against potential losses, as well as deferring a buyback of its own stock. Though to its credit, Barclays moved to quickly hedge the positions resulting from the overissuance when it first discovered the error. Regulatory scrutiny and litigation won't be far behind the repurchase, which will begin on August 1st and last for 30 days, and the bank has set aside another $1.2 billion to cover legal fees and any fines or damages awarded against it.